Hello, guys. I welcome you guys to this edition of Chat Talk Before Bed, episode 4. We are actually growing and then we are moving forward. It's been an awesome program, and I know that a lot of you are gaining value from the episode we've had so far. Most of you are gaining value from the content. Okay, we've taught so many things in the past. We've taught about trading strategies, and then how to actually become a better technical analyst when you're looking at the chart, know what you're looking at for and all of that. So today is actually packed with a lot of value bomb. In fact, if you missed this section today, you've really missed a lot, because we are going to be discussing so many things that are very, very important that will actually help you to improve your trading. Okay, so we'll have a lot of things to discuss today in this episode. Okay, so we're going to look at market structure again. We'll look at market structure again. We'll look at harmonic patterns, and then we'll look at liquidity. We're going to define liquidity in a way that makes a lot of sense. Okay, I've been doing a lot of studies, and it's something I'm going to share with you guys during this section. Okay, so we'll look at redefining targets for harmonic patterns. Okay, we'll look at harmonic patterns, then we'll look at entry again, and then we'll look at journaling and tracking your trading psychology, and then setting goals on each trading account. So I'm going to share the Excel file with you guys at the end of the section. You can make a copy of the Excel file and how to actually, journal your psychology, journal your trade. If you prefer to use Notion, I'm also going to show you guys how to also do that on Notion again. So today is a practical. In fact, if you have a laptop with us, you can as well do most of the things I'm doing practical. It's going to be a practical video. You're going to watch me do a lot of things practical, so you can as well go do it alongside with us. Then we'll look at review of past trade. So there are some trade that actually ended. I want to make a quick review on them so I can as well learn one or two things from those trades. So you can see that we have a lot of things to cover today in this section. So if you are going to be watching the recording and then you have any patience or whatsoever, please, even though if you're live with us, you can use the chat. You can use the chat icon to send message. I will read it out and then we'll talk about it. So I have Divine live with us. I think that's the only person that is live here with us right now. So Buddy, what's up guy? How has it been? How is everything going on over there? How is life? How is business? How is the hustle? How is everything? Hope you are doing great and hope you are pushing forward regardless. So hope everything is moving fine at your end. I'm glad to have you. I'm glad to have you live here. So at the course of this live, if you have any question or whatsoever, please do not hesitate to drop a chat. Or you can as well unmute yourself and ask your question. Okay, so that would be great. That would be nice. So let's get it started. We don't have much time. I don't want to make sure that this section end as late as on or before 9 p.m. We are done with everything we are going to talk about today in this section. So let's start with market structure. Now we know the basic market structure. Okay, we have if we are in a bullish market structure, we want to see price moving in this direction: higher high, higher low, higher high, higher low, higher high, higher low, and higher high. So when market is in this kind of trend, moving in this form, okay, we are saying that the market actually was in a bullish trend. So until this trend changes, you have to keep looking forward for buy. And it doesn't even matter the time frame. But then more especially when this kind of structure has established on the higher time frame, we say the daily time frame, the 4-hour time frame, okay, even the 1-hour time frame. So until we have this structure shift, now we can say that market is actually in a bullish trend because it's making a higher high and higher low. Now for downtrend, the same thing. We have market moving with lower low, lower highs, lower low, lower highs, lower low, lower high. So when you open a chart, the first thing you have to look out for is to determine the trend. What is the trend? Are we in a bullish trend or are we in a bearish trend? What is the structure? What is the current structure? So market structure is the way the market is the way the price action is moving at that particular point in time in that particular pair is the way the price action is moving. Is it moving in an uptrend? Is it moving in a downtrend? Or is it consolidating? Meaning that there is no direction. There is no direction. So price is moving up, moving down, moving up, moving down, moving up, moving down. So you can see price moving in this direction. Okay, so you say that this market is not in a trend, but then whenever you see price moving in this direction, you can see that market is actually in a trend, either in a downtrend or in an uptrend. Now, the bulk of our entry comes with this with knowing this movement of price. Okay. Now, when we start to look at for entry, we start to look at for harmonic pattern into this key level. Probably you have a harmonic pattern of this form into this key level, and then you start to look at for what we call structure shift. Structure shift will let you know if actually this harmonic setup you have here, if it's going to hold or not. I think it's best for us to use example of trade to explain this concept of market structure very well for you all to understand. So we start to look at for structure shift. That is the first thing, is the first indication that we are ready to sell this market. You see, the market will make a displacement. Okay, immediately market makes a displacement, then we can now say that, oh, probably this market is ready to actually drop. Now, what happens? The market will do what? Will correct back into this level, and then we start to look at for entry to the downside. So this is basic market structure, and it's very, very important to understand that this is how we look at it. So as price is breaking these highs, we can say that this is what we call break of structure. So price breaking the highs, respecting the lows, we can say that price is breaking structure to the upside, meaning that we are in a bullish trend. In the other way around, if price is breaking structure to the downside, we can say that price is actually in a bearish trend, meaning that it is respecting the highs and then breaking the lows. And then when price takes out the first pullback in this form, when price takes out this last pullback, we can say that the structure have shifted from bullish to bearish, or vice versa, as the case may be. Okay, yes. So now, either you call it change of character, or you can just emphatically say it is what? Market structure shift, MSX in short form. It is the same thing. So we can say it's market structure shift, or we can say it is what? Change of character. It is just the same thing. Okay, so this is just basic market structure. So let's look at some couple of trade that has played out. I think I was able to catch one or two trades in the past. So we're going to look at most of the trade that we have so far, so we can actually learn from what has happened in the past. So let's look at Euro GDP trade. Let's look at Euro GDP trade. Now for this Euro GDP trade, let me just switch off most of the things here. Let me switch off so many things here. Okay. Let me switch off so many things here. Good. Let me leave only the key levels to be here. Okay. So this is Euro GDP. So if you have your laptop open, if you have your chart open, you can just open the Euro GDP pair, Euro GDP pair. Okay, you can just open it up. Let's look at this particular pair and analyze it together based on the opportunities we actually saw and how we're able to capitalize on it. Okay, so now the first thing we have to look at for is to know where price is at the higher time frame. Okay, so let's start from the daily time frame. Now, when price was here, let me just cut off. I think I can use the replay tool. Let me cut off this guy. We are now on Euro GDP trade. So I'm going to analyze this trade. We are going to learn one or two things from this particular trade, from this particular pair, and the setup we actually had on this pair. Okay, so we are going to learn one or two things from this particular pair right now. Okay, good. So now the first thing you should do whenever you open a chart, the first thing you have to do is to look at the higher time frame. Where are we on the higher time frame? Is price approaching the significant key level on the higher time frame? Say the weekly time frame. I always use the weekly time frame. Okay, is price approaching a higher time frame? Where are we? Or is price trading off of a higher time frame? So what is happening on the higher time frame? That is the first thing we need to do. Now for Euro GDP trade, we actually caught the sell and the buy at the same time. And that is why this particular pair is significant for this study today. So let's look at what happened here. Now, this was actually April 25th, 2025, this year on April. And when I came to the higher time frame on this particular pair, and then this pair, Euro GDP have a very strong correlation with Euro USD. Euro GDP has a very strong correlation with what? Euro USD. The most important aspect of this chart talk program is to talk about some certain things that you rarely hear online. We talk about some certain things that most of the things you see, most of the things you watch online may not be able to explain those concepts to you. So I want to make sure that this particular program can be able to cater some certain things that are not being dealt with whenever it comes to trading. There are some certain things that we overlook, more especially the aspect of psychology. A lot of people don't really show you what is actually psychology and how to handle it. Most of them present their strategies and their concepts in a way that they don't take losses, in a way that they don't actually have these psychological issues. They are not bothering, that they are okay, they are fine, they are not. A lot of people are in this category. So the essence of this program is to talk about trading in general, talk about some psychological aspects of trading that a lot of people overlook that actually affect us as traders. Most of the time, it's not even about the strategy. It is sometimes it's about the psychological aspect of trading. It is the decisions we make on the chart. Trader A may enter trade at the same point where trader B is entering the same trade. Both of them enter at the same time in the same pair. Let's say, for instance, this Euro GDP trade now, I drop the signal, a lot of people enter at the same time. Now, the difference between Mr. A and Mr. B trader is in the decision that each of them are going to make on that particular trade. When they enter the trade may start ranging. It may start going to stop loss. Trader B may decide to close, thinking that, oh, I don't want to lose this $100. This is my last, this is my last fund. I don't want to lose this money. So because of that, let's say he has taken a over leverage. He has actually risked more than $60 on that particular trade. Now he will close, and then he has lost $60. It's remaining $40. But then trader B will be like, okay, fine, my analysis is correct. I've seen this kind of thing play out in the past. Even though the trade is going is not going in my direction, I'm going to allow it to play out. I'm not going to be scared. I'm going to control myself and allow this trade to play out. And I'm not going to take any other trade until this particular trade plays out. Okay? I want to combine so many things at the same time so that we can be able to utilize our time very well, because time is not in our side. So trader B will be like, okay, my analysis is correct. I don't want to touch this trade. I want to allow it to play out. I want to remain calm, and I'm already tracking my psychology on this trade. Okay, the psychology of fear of missing out, impatience, patience, and then greed. I'm trying to track everything together. So on this particular trade, I want to keep all the psychology aspect of trading. I want to keep them normal. So meaning that I'm not going to touch this trade. I've already calculated my risk because I've already set goal on this account. So I'm going to be risking this amount of money on this account. So I already have my goal. So I'm following my goal. I'm not over leveraging. So I'm not going to be scared. So I'm going to control my fear. I'm going to be normal. I'm going to be calm and allow this trade to play out. If it hits my stop loss, I will accept the loss. But I'm not going to be taking any other trade until this particular trade plays out. So even if I see a setup on another particular pair, I won't trade it because of the fact that I have a plan and I want to maintain that particular plan. Since my plan does not allow me to take any other trade until this particular trade I'm on plays out, so I will maintain this trade and I will hold it until it plays out. And then guess what? This trade did not hit stop loss. It reversed from that particular point and then went straight to take profit level. Now trader A has lost $60, left is $40. Now trader B did not lose any other money, did not lose any money because he remained calm. He was able to handle his emotion very well. He was able to make $700 on that particular trade. You can see that it is not about the strategy. It is not about the strategy. It is the decisions we make on the chart. It is the decisions we make on the strategy. That is what differentiates us. I learned this concept from One man I normally follow on Instagram. I also join most of his live on YouTube. It's called FS Daddy. He was talking about, traders making different decisions on psychology. That is what affects. Most times it's not about the strategy, it's about the decisions we make. We might have the same setup, the same everything, but now you may decide to close. You may decide to, this trade, I'll just close it. I have another setup I want to trade. Okay, and then the other trader will be like, okay, fine, my analysis is correct. I'll just allow you to play out, even though it's going to be a loss. No problem. I'll maintain it. I'll just allow you to play out. No, I'll accept the loss. You can see. So it is different. You see. So that is what we have to understand. And then at the end of this program, at the end of this episode, I'm going to show you guys how you can track your psychology on every particular trade you are taking. First of all, how to actually have a plan to work with on that account. How to have a plan. So let's talk about this Euro GDP trade. We caught the sell and the buy at the same time. First of all, like I said before, whenever you open a chart, the first thing you need to do is to open up the higher time frame to know where we are. What is the story? What is the current story of the markets? Are we bullish? Are we bearish? Is price getting to a higher time frame key level? All of that. Okay, so now the sell. So when I came, I saw that price was already here. Now there is something I want you guys to understand. Most times it's gonna be on the daily and the weekly time frame. What is the pressure of the market when price came to that key level? Do we have a bullish pressure or do we have a bearish pressure? Now, most of the key levels you see, like for instance, when price came to this key level, there were no bearish pressure. When price came to this key level for the second time, there were no bearish pressure. Now, let's go to the weekly time frame. Now, on the weekly time frame, that's when we start to see things clearly. First of all, this was the key level I marked out. You can see how price broke through that key level. And one thing about our strategy is that it gives us ample of time to even plan for the trade. Most of the analysis you're going to do, you do it at the end of the week. Saturday, Sunday, even before markets open, you do your analysis, you do your, look at the weekly time frame to know what is happening on the weekly time frame. Okay, so when I came at the end of the trading week, I saw that price has already broken out of this key level. So first of all, this one is off, right? So now, where are we? We are on this key level right here. You can see that this is actually a valid key level. And if you look at it closely, you find out that was actually a valid order block. So let me even remove this. Let me remove this. So now, if you look at this thing very well, you'll find out that this one, when price came here for the first time, it was respected. Now, you can see that, first of all, this right here, on the weekly time frame, this is a break of structure. This is a break of structure. This is a break of structure. Okay. And all of that. So I don't want to go into all those break of structure that happen. So we are actually on the bearish trend. So when price came back again to this key level, this was what? Valid. This key level was valid. Okay. Beautiful. You can see our price tested that key level, and then we had a massive drop to the downside. The same thing happened, but then finally we had a structure shift and all of that because price came to another key level, right? You can see that this was also a valid key level that price came to, and then you can see most of these things is something that we can as well do, and it's very, very simple. And then you can see that when price push all the way up, if you go down to the lower time, you can see that this was a market structure shift. It is a change in trend. Okay, now after this market structure shift, the first pullback that the market makes is an inducement liquidity. Now let me go back and explain this concept for you guys. Let's say for instance, we are now in a bearish trend. Market is making lower low, lower highs, okay? Lower low, lower highs, okay? And then price change direction. We had a market structure shift. This first pullback that the market will make is called inducement liquidity. Then what price will do is that price will break out of this place, okay? It depends on where the inducement liquidity ends. For instance, most of the inducement liquidity will just be something like this, and then price push all the way up again, right? Now, what happens here is that we had what? Market structure shift here. After the market structure shift, the first pullback that the market makes is what we call inducement liquidity. Okay, this is what we call inducement liquidity. So now this is your liquidity. So you have gotten your market structure shift, you've gotten inducement liquidity. I know I've not said this before, but you guys are smart. So as I've even said it now, you guys should be able to understand it going forward. If you go back to your chart, you're going to see all of this in place out. So this is the first pullback the market makes after this after this market structure shift. It is called inducement liquidity, that first pullback. Now, what happens is that price will come back, take out this inducement liquidity, and then react from your what point of interest. It will react from any point of interest. It will react from come back to this level of demand, okay, or retest this level of resistance that was broken out. That is what we call breaker block. Now, this is an order block that was supposed to hold price from pushing all the way up. Now, when price breaks through this order block, it becomes a breaker block. It's just that simple. It's just a resistance that was broken. The order block that was there that was supposed to hold price from pushing up, that order block, price will come back and retest it. Price will come back and do what? And then tap into this order block that was supposed to hold price as a breaker block. Now, this depends on where the inducement liquidity is. You're going to use the point of interest that is closer to the inducement liquidity. For instance, if the first pullback that the market makes after this market structure shift, it did not mitigate this resistance or this order block that is here, it just came very close and then pushed all the way up. Now, this one becomes your what? Your point of interest. But then, if this inducement liquidity, that is the first pullback, was able to push down, mitigate that breaker block, and push all the way down here without, mitigating this other block. Now, your POI, your point of interest for this entry, becomes this order block at the demand level. I hope this is very clear. You guys are smart, and I hope you guys are taking record. Of course, the session is being recorded. So this one now becomes your what? Your point of interest. So it depends on where the inducement liquidity is. And that first pullback that the market makes is your inducement what? Liquidity. Okay? So I hope that has taken care of itself. So let's go and see what happened here on this trade. Now, price reacted from a lot of key levels and all of that. Now, when price came here, I actually caught this, this sell. Now, what happened was that I already marked out this order block. I said, okay, fine. Let me see how price will react from this order block. Okay, now the week I came, I saw all of this, and I went down to the daily time frame. I went down to the daily time frame, and then I saw that, oh, this is what it's actually looking at for. And you can see that after this break of structure, on the daily time frame, after this break of structure, now the pullback that price made a lot of pullback. Okay, look at price made a lot of pullback, but then you can see that it was just making a lot of pullback. You can see a lot of pullback it was making, and all of that. And every time it just came, and then we had another break of structure. So what's happened is that this is the final pullback that price made. So this becomes what? Your what? Inducement what? Liquidity. So meaning that price will definitely take out this guy out on the higher time frame, and which of course finally did. It's making a lot of sense now, and I hope you guys are getting value. So now we have this what key level that is here. I said fine, there's no problem. If we're going to hold this, if this key level is going to hold price, we are definitely going to see a market structure shift. I don't even need to stress myself. If it's not going to hold, there is no problem. If it's going to hold, we wait for market structure shifts, either on the 1 hour time frame, 15 minutes time frame, or thereabout. So, but then before we start looking at for all of those information, do we have a strategy? Do we have a setup here? Okay, let me look at that setup. Do we have a setup here? Great. So we had a setup there, and that is what we call, let me just do this for you guys clearly. I'm going to hide that, and I'm going to be very, very quick. I don't want to go into full details. We had what we call a deep crab. So this is a deep crab. Let me just use the measurements. At the end of the week, I normally do all of these things at the end of the week. I'll just come and then analyze the chart and see what is happening based on the weekly time frame. Okay, fine. We have this deep crab. You can see. Let me see if I can enlarge my screen for you guys. Okay, I can't do that. I can't do that right now. I can't do that. But then I hope you guys can see this. I hope you guys can see this. This is 0.886 and this is what? 1.618. And then you can see that for crab deep crab, we look at 1.618 and 1.902. 1.9002 and then 1.618. So let me play this for you guys to see what happened here. Great. You can see that price tested 1.618. Let me even remove the replay too so we can be able to look at these things together. So now price tested 1.618. But what happened? Do you have any kind of structure shift after that 1.618 text? Now on the 1 hour time frame, if the 15 minutes time frame is too what do I call it? If the 15 minutes time frame is too, if there's so much candles on 15 minutes, you can look at it from the 1 hour time frame. First of all, we had a structure shift. I won't lie to you, and this was valid. This structure shift was valid. But then what I look at for is, you can see that we had what? Break of structure here, and then we had what? Structure shift here. So it was valid. But then there was a problem. What is that problem? There was no inducement liquidity that was closer here. There was no liquidity. And I want you guys to be looking at these things once you're picking your point of it, once you're picking your entry right now. You can see that there was no inducement liquidity. After this structure shift, we didn't have any pullback, something like this. It was just purely straight up. But then what happened here? What happened here? Remember that we had price broke out. We had a break of structure. This was a break of structure here. Okay, this is a break of structure here. And then this is a pullback that price made. Okay. That's the first pullback that price made. Look at it very well. That was the first pullback that price made. And then, like I said before, this right here, if you go down to the lower time, you can see that this right here, that was supposed to be an order block here that was supposed to hold price from pushing all the way it was up. But then what happened? Price came back and then pushed into this what? Breaker block and then pushed all the way up. But then what happened? Why did this one fail? The reason why this failed was because there was no what? There was no inducement liquidity. There was no liquidity. So price used this guy as a liquidity. There was no liquidity. Price used it. So then, but what happened here? Look closely and you will see what happened here. I'm running out of time, but I'm going to explain this concept for you guys. See what happened here. We had what? A sweep. We had what? A sweep. Once you have a sweep, listen guys, let me just round up. Once you have a sweep, you don't need to look for another inducement liquidity. Is that clear? Once you have a sweep, you don't need to look for any inducement liquidity. All you have to wait for is structure shift. Let me see if I can go down to the 30 minutes time frame and look at this closely. Once you have a sweep on that high, you don't need to look for any inducement liquidity. Let me explain with this concept. If you have something higher high, higher low, higher high, higher low, and then you have a sweep, just a little sweep, and then displacement. Even though you don't have any inducement liquidity here, just use what we call aggressive entry at the what? Either at the fair value gap here or at the order block. And then price will come back and react from here. Provided that we have had that sweep, that entry is what? Valid. Same thing happened on US oil. If I have on the part 2, I will talk about US oil trade. So we can look at that together again. So provided we have a sweep here, you don't need to look for any inducement liquidity. But then, if we don't have any sweep at that high, we'll have higher high, higher low, higher high, higher low. And then we'll have break of structure. And then price does something like this. And then it did not make any pullback. It just continued to do something like this. This POI will fail. This POI will fail. Except price comes back into this place and then push all the way down. Then we can start to look out for entry from here. But provided that this does not happen, doesn't happen, this order block here or fair value gap here will not hold price. But then if price does something like this, then even if it's just something like this, and then we can now look at for entry from the fair value gap or from the other block here to the downside. So you can look at these two things together now. So this one is a sweep. Why this one is not a sweep? This one is a break of structure. This one is a break of structure. So for break of structure, we look at for inducement liquidity before entry. But for sweep, we don't look for inducement liquidity. We just wait for that structure shift here, that market structure shift here, and then we can now pick our entry from that high. So that was what happened here on and then for the what do you call it? For the indicator, I'm using what we call SMC order block by Truth Indy. It is already on the HSM website. If you go to software download, you will be able to see this indicator and add it to your indicator. It helps you to identify the chalk and the break of structure. It helps to do that clearly. This SMC order block by Truth Indy. So I'll actually paste the link at if I'm posting the video on YouTube, I'll paste the link for you guys to have access to it. Okay, so that is what we use here. So now what we have here is I want to check that entry very well for you guys. What's happened here? Great. So we had a sweep. Okay, so we had a sweep. Great. So after that sweep, we had what? Market structure shift. Right now you can see that this was a break of structure. It was not a shift. And then what happened here? There is no inducement liquidity here. There is no liquidity. So this was a break of structure, not a sweep. But then since we have a sweep here, there's no problem. If I have an order block here, it will become my entry. So this right here becomes my entry. This is the order block. So this becomes what? My entry because of what? That high has been swept. Okay. So if you don't want to catch all of this information, you can still look at it from the, let me switch this off. You can look at it from the what? Reversal candlestick formation. You have what? Bias exhaustion here. So if you don't want to go into that route or looking at for structure shifts and all of that, wait for clear reversal candlestick formation on the higher time frame. You pick your entry. But then the only difference is that someone that's looking out for market structure will have an entry before you. So that is the little work the person did, and he should be appreciated for that. Okay. So now that's the thing. So now both of you, trader A and trader B, has taken this entry, but then not all of them will hold to take profit level because of what the decision they are going to make on this trade will determine how much they're going to make on this particular trade. They have taken the same entry, but then because of different decisions, they are not going to have the same result. So now this is what we have. I think let me just enclose that. I want to make sure that you guys are getting the whole thing very well. Where is that guy? This is supposed to be okay. I've seen it. It's here from this guy. In fact, when I took this entry, I was on a Telegram live with Archman. Yes, the same day I took this entry, I was on Telegram live with Archman. I took the entry. It was in the afternoon, around 1 o'clock or thereabouts. I took the entry. I just saw how the bearish candles.
Yeah, even me, I took the entry.
Exactly.
Small profit.
Exactly. So I saw how
I closed early.
Exactly. Even me too. I closed early. So now, at the end of this episode, we are going to look at something that will help us to track our emotions whenever we are on a trade, based on the plan we have set up for ourselves. So I may not really have time to explain everything on this particular part 1. Probably on the part 2, we'll talk about those psychology and all of that. Now, redefining targets. So for harmonic pattern, let me just do this quickly. Let's redefine our target. Initially we'll be using 0.382 and 0.618. Let's look at for bullish harmonic pattern. Let's look at a pattern of this form where this X8, where the A point was not taken out. Let's look at a pattern of this form. Great. So redefining targets. Now, when you have a pattern of this form, probably a bat, a Gatly, or an alternate bat, something of this form. Now, your first target is going to be at this point. I've already used something like this to mark it out for me. This is going to be your first target. You don't need to start looking at for all of those 0.38. Don't do, just use this particular concept, and then of course have your own personal target as well. Okay, but your first target should be here, and the final target is going to be here, because these points are liquidity point that price is going to take out. These points are liquidity point that price is going to take out. This one is definitely going to hold. This one may take time to hold. So these are your two targets for this particular type of harmonic pattern. Now let's say you have a harmonic pattern of this form, where price took out this particular one and then does something like this. It doesn't matter whether it took out this one or not, provided it's something like this. The same thing here. Your first target is going to be here, depending on where this one is. If this one is very close to this point, then your first target is going to be here. Okay, this one is going to have three targets. It's going to have three targets. First target is going to be three targets. This is a target. Final target is this place. That's why I like shark. I like shark and cipher patterns because they give me higher risk to reward. Even crab patterns, they give me higher risk to reward. I love them so much. They don't come often. So hope this is very clear for you guys. Hope this is clear. Please take a screenshot, snap it. It is just that clear. This are your targets. So now with the same concept, let's look at this Euro GDP trade and look at how to redefine targets on this trade. Now, since we have mapped out all of this information, the next thing we have to now do is to track our emotions on this trade. Now, what is the ideal thing? We have fear, we have greed, we have fear of missing out, greed, impatience, trading multiple pairs. So all those psychology, you record them on this particular on this particular trade. So you need to now track your psychology as this trade is playing out. Now, the original thing is that you are supposed to hold this trade and do not take any other trade until this particular trade play out either in a loss or in a profit. Now, until you have secured profit on this trade, you are not supposed to take any other trade. Your first target on this trade is here. It may be here, but there's another liquidity point here too. This is another liquidity point. You see all those retracements that price made before tapping into your key level. They are called liquidity point that price will take out. So these are your targets. This is another target. My time is up. So I'm going to start the new